Life insurance also can play a critical role in your estate management, particularly when used in conjunction with a trust. Life insurance can provide money to your heirs, to charities, to help pay for estate expenses. It can also be set up outside of your estate, and you can even gift life insurance policies. You can also use it for tax-efficient asset accumulation. That makes life insurance another very powerful tool. Let's look at just one example. Under this strategy, a person establishes an irrevocable trust and funds it. The trust then purchases a life insurance policy on the life of the person that established it. This effectively removes the life insurance policy and its eventual benefit from the person's estate. Then, when the person dies, the estate passes to his or her heirs, and the life insurance policy provides the funds to pay any estate taxes that come due. Let's go back to that Aretha Franklin example. Her estate paid somewhere around $23 million in estate taxes. Proper planning might have helped pay those taxes. For example, she passed at age 76. If she had started her planning 20 years prior at age 56, and let's just assume that she was perfectly healthy, no health concerns or conditions or anything discovered at the time, let's say she took just 5% of that $23 million number that was due in estate taxes. That means 5% of $23 million is $1,150,000. Now let's say at age 56, she decided to buy a 25-year term life insurance policy. If we divide $1,150,000 by 25, that gives us $46,000 that she could have contributed a year to this estate protection strategy. A simple quote ran today could have given her protection of $12 million. So if we double the premium, we could double the protection, and I'm pretty sure that would have eliminated most of her estate taxes due. Now let's not forget, this life insurance policy will need to be owned by an irrevocable trust, or an ILIT, in order to remove it from her gross estate calculation at her passing. If she owned it outright in her name, then that death benefit could be added on top of the gross estate, and we certainly do not want to do that. This is a strategy that allows you to leverage current dollars for a future use. Her 25-year term life insurance policy would have expired when she turned age 81, but since she passed at age 76, this would have significantly helped her estate. She also could have converted that term policy to a permanent policy if she had lived longer, or when she discovered she had pancreatic cancer. She also could have sold that policy as well to ensure its usefulness in the protection of her estate. Now, of course, there are several factors that will affect the cost and availability of life insurance, including your age, health, the type and amount of insurance you purchase. Life insurance policies have expenses, including mortality and other charges, and not all of them are convertible, so not all of them are created equal. There is a lot that goes into this planning. Creating an ILIT also involves additional expenses and upkeep annually at certain times. So having the right planning advisors and team is crucial. I can't say it enough. There are a lot of moving parts, and we can help guide you through all of these options. Remember in the beginning, I said another famous sports team owner was not able to preserve the ownership of his team? Joseph Robbie was founder of the Miami Dolphins football team, but in the end, his team and the stadium Robbie built in 1984 with $115 million of his own money had to be sold by the family to pay an egregious amount of estate taxes shortly after he passed in 1990. Now, Joe Robbie didn't ignore estate planning altogether. He had an estate plan with a pour-over will and a revocable inter vivos trust. Remember, there's lots of different trusts. This meant that everything in his estate would go into the trust at the time of his death and would provide for his wife, Elizabeth, with income for the rest of her life and then to the named beneficiaries. However, there was not enough income in the trust to provide income to Elizabeth, and because his assets largely consisted of the Miami Dolphins football team and the Joe Robbie Stadium, she filed a petition to opt for an elective share of her husband's estate in March 1991. Rather than leave her interest in the control of the trustees,
Elizabeth decided to seek 30% of her husband's $70 million estate due to her under Florida law. This is called the elective share. And in September of 1991, the trustees asked for a delay in providing her share, but Elizabeth, as the beneficiary, wanted her cut and wasn't going to wait. There was unfortunately not enough cash to pay the $47 million estate tax bill, so the only solution was to sell the Dolphins and the stadium at fire sale prices. The dilemma created tremendous bitterness and resentment within the family and effectively destroyed everything Robbie had spent his life working for. All of this could have been avoided with a different estate planning strategy that included some more complicated trust structures and some life insurance. If he had established a life insurance trust and bought enough insurance to pay the estate taxes, the family would not have been forced to sell the team, and the stadium maybe would still be called the Joe Robbie Stadium to this day. So I probably said something that made you say, huh, what? ILIT? What is that? An ILIT is an irrevocable life insurance trust. It is created by an individual, the grantor, during his or her lifetime. The ILIT owns a life insurance policy on the grantor's life via the transfer of ownership of an existing policy or through the grantor's annual contribution of cash to pay the premiums on a policy purchased by the trust. The grantor designates beneficiaries, usually family members, who will typically receive the proceeds upon the death of the grantor. The trust is irrevocable, meaning that the grantor forfeits all rights to the property contained inside of the trust. Its irrevocable nature is integral to accomplishing the ILIT's objectives. So what can an ILIT accomplish? The ILIT may be able to accomplish several estate objectives, including meeting liquidity needs, managing estate taxation on the policy proceeds, providing income to survivors. When you die, the trust is designed to receive a payment equal to the policy coverage amount. Since the trust ownership of the policy is irrevocable, the proceeds are not considered your property. Consequently, they do not fall into your estate, thus potentially avoiding estate taxation. Remember, generally no income tax is due on such life insurance proceeds. The trust provisions should be set up to provide direction about how and to whom payments may be made. You may direct that trust pay out cash to cover certain expenses like funeral costs, probate, taxes, final medical expenses, and debts. This may obviate the need to sell less liquid assets in an inopportune time to cover such cost, like the Miami Dolphins football team. The trust beneficiaries may receive the proceeds after any payments are made to satisfy liquidity needs, creating an inheritance free of estate taxes. Finally, creditors should not be able to attack these assets since they belong to the trust, not you. Creating an ILIT should be done only with the assistance of a qualified estate planning attorney. It is a complicated exercise in which mistakes may result in losing the benefits of the ILIT offering. This ends our series on estate planning and why it matters. Hopefully you've gotten some useful ideas to safeguard your own estate, and if you have more questions, please do not hesitate to reach out. There are a number of tools available to assist you in effective estate management. But first, you need a good estate management team in place, and that's where AKH Financial Corp comes in. Our firm can help you implement an effective estate strategy. If you think it may be time to take a closer look at your estate management, your life insurance, your long-term care, your investments, schedule a complimentary consultation today. Also, if you like this video, please give it a thumbs up and subscribe to my YouTube channel or share it with a friend. Thank you for watching The Money Mindset.